Okay, thank you very much, ladies and gentlemen. I hope you enjoyed your lunch. It was really nice, and I hope you got a chance to have a chat with the offer people or our sponsors today, outside in the hall, outside behind. First of all, I suppose I always say we go forward by going backwards first, and I'd just like to recap on the events today. I think our 2 sessions this morning have been really insightful, and I'd like to thank our speakers throughout the morning. Their knowledge and experience and opinions and wisdom has been invaluable and has led to a great morning session so far. So, moving on to this afternoon's session, it is a general interest session for all members. Donald Dwyer is here from the FTC Group, and he will give us a tax update. Emma Darcy is joining us from the REA Group, and Emma will talk about the marketing of your properties and the best way to do this. After Emma, we'll come to Ed Carey of Ed Carey Property, who will talk to us about the importance of letters of engagement. And then our speaker will be Mark O'Connor from the MFO, the Property Professionals, who will talk about contracts and his top tips on those. Again, as I said earlier on, if you have any questions, please feel free to join in the Q&A session after the event. And our final session today then will be, I'll be joined on stage by Shirley Coulter, our CEO, and we'll just have a brief, I suppose, recap on what's been going on in the SSI in the last couple of months. So, without further ado, may I introduce our first speaker for the afternoon session, and that is Donald Dwyer. Donald is from FTC, the Farm Development Co-op, which began in 1973. It says here in my notes, in a small rural village of Demanray in West Cork. I come from about 3 miles outside Demanray, so I can tell you it's not a rural village. They'd be very upset if they heard that, but it is a good town, and it was established by a guy called Jack Murphy. And today FTC Group, its headquarters are in FTC House in Wellington Road in Cork. And it says here, as a decentralised multidisciplinary professional service provider, FTC offers a unique value of rural Ireland and continues in your delivery of full service offering via a local presence to the farming and business communities which FTC serves. And FTC is committed to having a strong presence where our clients are located throughout Ireland. So without further ado, may I invite Donald to the podium. Thank you. Thanks, Donald.
Good afternoon, everyone. Thanks, TJ. So as TJ said there, I work with the FTC Group. I'm a tax advisor in the tax department of the group. I suppose what the tax department would specialise in is we deal a lot with land transfers and land sales, and generally the capital tax implications of property transfers. So this afternoon I'm going to go through, I suppose, some of the taxes as they apply to property transfers and, I suppose more importantly, the reliefs that are available. So to begin with their stamp duty, as we know, the rate on residential property is 1%, where the property is worth €1 million or less, and 2% on the balance over $1 million. Commercial property, 7.5%, which is quite a substantial increase from 2% in October 2017. So commercial property, as we know, includes farmland and forestry land. So that increase in stamp duty has upset a lot in the farming community, but it doesn't seem to have impacted much on the sales of land. Just some of the reliefs on stamp duty. There's a stamp duty refund scheme where somebody pays the commercial rate on a site with the intention of building a house. So if that person commences to build a house within 30 months of the stamping of the document, they're entitled to a refund back, whereby they would effectively pay 1% the residential rate on that site. Consanguinity relief then, previously consanguinity relief wouldn't have been claimed that often because there was the conditions for the relief required that the transferor fell within a certain age bracket. But when, in 2017, when the rates went from 2% up to 6% consanguinity relief, the conditions were relaxed significantly. So now there's no age condition attached. So where you have family transfers of land, the 1% rate can apply. So again, where consanguinity relief is claimed, there is a requirement to avoid a clawback of stamp duty, so that the land must be actively farmed, and that's common enough that's common. You'll see now later on that with agricultural relief for CAT, that there's a requirement there that the land must be put to must be actively farmed, either by the person receiving the land, or the person receiving the land does have the option to lease the land to an active farmer to avoid a clawback of relief. So another stamp duty exemption there, quite commonly claimed, is the young trained farmer exemption. It provides a complete exemption from stamp duty. Obviously, the person claiming the relief must be under 35 and have a Green Cert or some other equivalent qualification. There is a requirement now that was emphasised a few years back in one of the budgets, that a business plan must be submitted to Teagasc, and a cert then, Teagasc will then issue a cert if they're happy with the plan, and that cert then allows the solicitor to stamp the document exempt. One thing about the young trained farmer exemption is that the young trained farmer must actually farm the land themselves, unlike where consanguinity relief is claimed or agricultural relief. So it's geared very much towards young people who are interested in farming. So there's no option to lease the land. The relief also applies to a farmhouse. So if land and a farmhouse was being purchased or transferred, the farmhouse would also qualify for the exemption. So forestry land then. Forestry land is effectively commercial property. 7.5% stamp duty. The standing timber, however, is exempt from stamp duty. The underlying land, I should say, is commercial property. So the underlying land stamp duty applies at the commercial rate. The standing timber is exempt from stamp duty. So if you're dealing with a sale of forestry or an inheritance or gift of, well, in an inheritance there wouldn't be stamp duty, but a gift of stamp duty, the valuer the auctioneer must value the standing timber separately to the underlying land. And often you will find, as I'm sure you know, the underlying land is often has a very low value. So that's forestry land. Leases then, very quickly, there's a stamp duty on a lease for residential and non-residential property, and the rates are there depending on the term of the lease. There is a stamp duty exemption for long leases of farmland, and as we know, there's also income tax relief available on certain leases of farmland. So on to capital gain tax then. Capital gains tax is the concern of the person who's disposing of the property, either they're selling the property or gifting it. There's no capital gains tax in inheritance cases. So basically the capital gains tax is 33% on the difference between the value of the property when it was acquired and when it was sold. So 33% on the gain. To offset capital gains tax, I suppose the first thing we would look at is, does the individual have any losses coming forward? So any prior capital losses, be they losses on shares or losses on property, can be offset against capital gains, and any capital losses in the same year that you make the capital gain can be offset against capital gains in the year. So it's always good to keep an eye on what losses your client has, because you might be able to offset them. So when the sale happens and capital gains tax becomes an issue, we have to look then at doing a CGT computation. So we will take the sales proceeds, and then we'll have to see, well, how can we bring the gain down? So you're entitled to deduct your legal fees, auctioneer fees, the stamp duty on purchase, any advertising or marketing costs, and I suppose you're entitled to deduct the legal fees on the purchase of the property as well. So it's not just on the sale. So any fees really that are incurred to get the property into your name and out of your name would generally be deductible. And I suppose any other ancillary costs may or may not be deductible. So I suppose enhancement expenditure then, you're entitled to take a deduction for any work that you would have done on the property the definition is there, I suppose, to enhance the value of the property that is reflected in the state of the asset at the time of disposal. So, for example, with a residential property, if you painted the property or something like that, that wouldn't generally be enhancement expenditure, but maybe if you upgraded the windows in a property or put an extension on a property, a residential property, the cost for that extension or upgrade you'd be entitled to take a capital deduction for that in your capital gains tax computation. So with land then, similarly, roadways, drainage works, significant fencing works, the cost of those upgrades, you would be entitled to take a deduction for those costs in your capital gains tax computation. So again, where you have a transaction that's not at arm's length, so typically a transfer of property from one generation to the next, even though there's no sales proceeds involved, it's effectively a gift. As far as the taxman is concerned, the transferor is deemed to receive the market value for that property. So sometimes that comes as a shock to people that when they're not actually receiving any money, there is potential for a capital gains tax liabilities, particularly obviously where gifts are involved. So indexation then, you're entitled to index up any costs that you have incurred throughout your ownership of the property. So just a quick example there, indexation, you can go back as far as May 1974. So any property that was acquired prior to May 1974, you're entitled to take a deduction for the market value of that property on that date, and you're entitled to index up the value of that property as the example shows there. So £100 or 127,000 euros, let's say, was spent on a property in 1974. The adjustment there is 7.528. So £100 back in 1974 is effectively worth 956 euros now in your computation. So if somebody spent €1,000 there, it's worth almost £1,000 back in May 74. It's almost worth 10,000 now. So 10,000 euros now. So reliefs then. There's an annual exemption every year. The first 1,270 euros of a gain is exempt for everybody. Transfers between spouses are exempt from CGT and stamp duty and capital acquisitions tax. PPR relief is a commonly claimed relief where a person is selling their home, the house that they would have owned and lived in. There's partial relief available if you lived in the house as your PPR for a certain period of time. So, for example, if you owned a house for 20 years and you lived in it for 10 years, well, approximately 50% of the gain then is exempt. Just one interesting thing I came across recently, principal private residence relief also applies to properties where a dependent relative of the owner of the property resided in that property, and that person lived there rent-free, the dependent relative lived there rent-free. So it can apply in situations where the property being sold is not actually your PPR, but your dependent relative was living in the house as their PPR. So it's not necessarily your own PPR that the relief applies to. So the 7-year CGT exemption, section 604A, that was brought in 2011. So any properties purchased between those dates, December 11 and December 14, and held and sold subsequently, there was a full exemption from the gain. That relief has expired since the end of last year. So any properties being sold now, it is only the gain arising in the 7 years that's exempt. But it's still a very valuable relief. So site to a child relief then applies where sites are being transferred from one generation to the next. A full relief from capital gains, the site can't be worth more than $500,000. But if the child doesn't go ahead and build a house and live in the house, the CGT will be clawed back if the child subsequently sells the land. So any CGT that would have been payable on the site transfer to the child will be payable by the child if they sell the property not having, if they sell the site, not having built a property and lived in it for 3 years. So one of the most important reliefs, I suppose, that we deal with in practice is retirement relief. So retirement relief, there's two aspects to retirement relief. There's one section that applies to transfers within the family, and there's another section that applies to transfers to third parties. So where you're dealing with a sale of land to a third party, the relief applies to €750,000 worth of sales proceeds. So basically, if the asset, be it farmland, typically farmland, is being sold to a third party, and the proceeds are 750,000, well, that sale is free of CGT. If the proceeds exceed 750,000, the margin between 750,000 and the sales proceeds, there's margin relief available on that. Now that 750,000 is reduced to $500,000 where the person selling the land goes over the age of 66. So between the ages of 55 and 66, there's 750,000 of relief, and thereafter then it's $500,000, and that again is on sales to third parties. When you're dealing with assets, transfers of chargeable business assets within a family, there is no limit to the value of assets that you can transfer to the next generation, while the transferor is under the age of 66. But then there's a cap of $3 million then thereafter. So where you have somebody with substantial farmland, you know, our advice would be to transfer it before they turn 66, otherwise you could be into problems. With retirement relief as well, if there is, when you're dealing with retirement relief within the family, there's also a clause in the legislation that allows for a transfer to a favourite niece or nephew. So where you have a niece or nephew working with the person who's transferring the land, retirement relief can apply to that niece or nephew in certain circumstances, as if the transfer was to a child of the individual transferring the land. So the general conditions, the disposal is made by an individual, so retirement relief doesn't apply to transfers of land out of companies, and the person must be 55 years of age or more at the time of disposal. And the asset must be owned and used by the individual in their trade for at least 10 years prior to the disposal. I suppose one thing about retirement relief, there's no actual requirement for the transferor to retire out of the business, so they can transfer on their assets, claim retirement relief, and continue to farm in some way, shape or form. So quickly there, retirement relief applies to chargeable business assets, so can include goodwill. Investment assets wouldn't be counted. So assets used in the business, so really it's farmland that we deal with mostly. So owned by the individual or the individual's family company. So I'll just talk a bit about, because companies are becoming more common now in farming, where you have a family company as distinct from, it's not, I suppose, it's not just any company that retirement relief can be claimed against. It must be a family company. So the person must have at least 25% of the voting rights in the company, or they must have 10%, and the individual and his family own 75% of the voting rights in the company. So it's not every company, it's really family companies where typically we see a husband and wife, or husband and wife and a child in a company. So where you have a family company, retirement relief can apply. Shares in a family company, I suppose one thing about farming companies is that the shares in a farming company are not of themselves agricultural assets, even though apart from cash, you know, livestock and machinery that are in the company would be agricultural assets, but the shares themselves are not. They're treated as any other asset, any other share in a company for, you'll see in a while about capital acquisitions tax. But so where you have a farming company, the shares in the company themselves will qualify for retirement relief, so long as the company has been a trading company for at least 10 years, and again, that the person, the shareholder, is at least 55 years of age. So that person then, the shareholder, must be a working director in the company for 10 years prior to disposal of the shares in the company, and they must be full-time working director for 5 of the last 10 years. So you can't be you have to be actively involved in the trade for the shares to qualify for retirement relief. So this is very relevant where now that, particularly with dairy, where you have a lot of farming companies, and you want to transfer the farming assets from one generation to the next. So it's very important that retirement relief is considered. So retirement relief as well, where you have a situation where you have land, typically what you will have with a farming company is the land will be owned by the individual but used by the individual's company in the trade. So that's fine, that land will still qualify even though strictly it's leased land. But so long as the land was used by the company and is disposed of with the shares in the company, well then that land will qualify for retirement relief as if the shareholder had farmed the land himself and not the company. So the timing of transfers of land when you're dealing with companies has to be considered because, as I said, strictly the land is leased land, an investment asset in the hands of the landowner while it's being leased to the company. So another relief then, revised entrepreneurs relief. It operates by reducing the CGT rate from 33% to 10%. There's a lifetime limit of €1 million, and that's on the gains, so not the proceeds, unlike retirement relief where the relief applies on the actual proceeds that you receive. Unlike retirement relief, revised entrepreneurs relief doesn't apply where assets are owned by the individual and used by the individual's company. So it's compared to the UK, revised entrepreneur relief it doesn't apply to development land either. So it's restrictive enough. A chargeable business asset for revised entrepreneurs relief purposes is an asset used for a qualifying business. But it wouldn't include investment assets or land sold for development. So a relevant individual then is a person who owns the chargeable business asset for at least 3 of the last 5 years. So that was changed in 2020, where previously the individual needed to own the asset for the 3 years prior to disposal, but now it's you can own the asset for 3 years anytime in the 5 years prior to the disposal. So that sometimes can be a help, particularly with shares in limited companies. So a qualifying business for revised entrepreneurs relief doesn't include holding of securities, investment type assets, holding of development land, or the development or letting of land. But farmland does qualify for entrepreneurs relief. So capital acquisitions tax then, very relevant where you're dealing with gifts and inheritances. The thresholds are there. Group A threshold 335,000, Group B 32,500, and Group C 16,250. So we're all aware of the threshold. So I suppose the main relief that we deal with in practice is agricultural relief. So basically the conditions for the relief, the person receiving the asset must be seen to be a farmer, must pass the farmer test. So it doesn't actually, they don't necessarily have to be involved in the trade of farming, but they're asset-based, including the gift or inheritance, must comprise at least 80% agricultural assets. Excuse me. So that asset test is very important, and a lot of our work is planning to ensure that somebody who's due to receive a gift or inheritance of agricultural property, that they meet the 80% test. Forestry land is slightly different in that there's no requirement to pass the 80% asset test when you're dealing with a gift or inheritance of forestry land. So how agricultural relief works is that instead of being taxed on the market value of the property, you're taxed on 10% of the market value of the property. So effectively what it means is that a parent can gift 3.3 million euros worth of agricultural property to their children free of CAT. Back in 2016 then, the actor farmer requirements came in, so the person receiving the land must put the land to good use. They must either farm the lands themselves or they must lease it to an active farmer for at least 6 years, otherwise the relief is clawed back. So that's agricultural relief. There's also certain other restrictions there on the sale, the clawback. If the land is being sold, if the beneficiary decides to sell the land for development purposes, that clawback period is extended to 10 years. So business relief then is similar to agricultural relief in that it reduces the taxable value of the asset transferring to 10% of its market value. With business relief, I suppose, I should have said about agricultural relief will apply to farmhouses to the extent that they're they fit the land that they're transferring with. So for example, if you have a period house and a small amount of land going with it, well, there'll be a question mark over the house itself is agricultural property. But ordinarily, where a farmhouse is in fact a farmhouse and it transfers with the land, the farmhouse will qualify for as an agricultural asset. But with business relief, residential property doesn't qualify. Also with business relief doesn't apply where individual assets of a business are transferred. So if a farmer, for example, was to, if we were looking at business relief in terms of a transfer of a farm, you'd be looking to see that the land, the single farm payment, the stock, the machinery, and all the assets of the business are transferring to the beneficiary. We wouldn't be able to qualify, you wouldn't be able to claim business relief if, for example, the land transferred and the disponer decided to retain some of the business assets. So it applies to where a business, all the assets of the business are transferred. So I suppose thanks for that. I suppose one other thing I forgot to mention there, dwelling house relief is another capital acquisitions tax relief that's available. Again, it was restricted significantly recently, so really it only applies on inheritances of property now. And to qualify for the dwelling house exemption, the person receiving the property must actually reside in the property with the disponer for 3 years prior to the death of the disponer and must stay in the property for 5 years afterwards. So whereas previously people were able to purchase properties, for example, in Dublin, let their kids live in the property for a few years and then transfer the property to their kids by way of gift, regardless of the value of the property. But that has been that loophole has been closed. So thanks for that.
Now then, thank you very much, Donal. Okay, our next speaker is Emma Darcy. Emma joins us today from the REA Group and is a business and marketing coach within the REA Group. Emma has a combination of over 15 years experience as an academic, in an academic background as well, and she has a master's in marketing, a degree in business, and a diploma in IT. So Emma helps businesses realize their ambitions and goals by helping them create and implement an innovative marketing plan that works. So without further ado, Emma, welcome. Thank you.
What do I click to?
Yeah.
Sure. Right. Perfect, thank you. Good afternoon, everyone. Very nice to be here. I hope you're having a very good day. So today, obviously, we're going to focus on marketing, and in particular, we're going to focusing on, how we're running marketing for the REA Group. So without further ado, I suppose, you're all in the room here, you're all in business, and one of the things that are always discussed is, how are you going to create leads? How are you going to get out front and center of people so that you're attracting new customers? It's the perennial problem for every single business, and the question is, how do you go about it? So I'm sure all of you have seen this before in terms of, you know, looking at a sales funnel, but I suppose you're looking, and this is just as a reminder to you all, it's looking at reminding people of who you are to attract them in, so it's not that constant sale, sale, sale. It's much easier if you can have inbound leads coming in. That is to say that you're attracting them in. The other thing, obviously, what you've got to do is look at aspects like converting them. So in other words, if people are coming to your website, if they're making inquiries, if they've got that far, you know, are you converting them from that point? So I suppose there's a series of steps that you would take, and I'll go through that in a moment. Obviously, then you've got number 3 there is the close, and that's really important as well because I'm sure, as you all know, you've got to ask for the business, and sometimes, you know, as business owners, we can forget to do that. You get so embroiled in the organization of it, the operational aspect of it, that sometimes people can get nervous or whatever the case might be, and I suppose my point being here is that it's very good practice to intermittently go on sales training so that you're constantly refining your closing skills because it's an area that often many of us can fall down on. The other thing then is not to forget the after-sales process. So in other words, if you have made a sale in whatever context that might be, that you're making sure that the customer is very happy with the service. And I suppose part of that is to make sure that you get good reviews on Google, for example, on Facebook, on your website, and also that you're getting referrals as well. That's obviously a very important aspect of marketing in general as well. You know, there's often debate about marketing and sales, and to me, they're both interrelated because without marketing, you wouldn't have sales. So you need to look at both of them in the context of your business. You know, we live in an era where, in particular, digital marketing has come to the fore in the last 10 years. And I suppose I'm going to particularly focus on that today. However, I would say to you that you should all look at an integrated marketing campaign. And what that is about is that you're making sure that you're covering off on all of the touch points. So for example, you can focus on digital marketing, and it's not to say that it's not good. However, as I've just said, word of mouth, referrals work very well as well. PR, so if you're getting covered in the papers and the broadsheets, on radio, if you're on podcast, if you're on video, whatever that might be. So you're using multiple different platforms. So I suppose what you're looking at then is that you are seen to be available in many different aspects. So as you all know, if you get an article written about you in the newspaper, for example, there's a lot of credibility around that. And I suppose what I'm saying here is to make sure that you're looking at all the elements because they're all important. It's not any one thing that typically works with marketing. It's a series of things. So I suppose one of the things in the context of digital marketing or your marketing in general, but I suppose specifically digital, is to have a content marketing plan. And you often, I suppose not many businesses really do this, and I suppose this is what you're doing really is being intentional about your marketing. You're planning it out in advance, and instead of being reactionary about it, you're just literally planning it out, be it every month or maybe for a series of months. And this can be very effective. It makes it, it ensures that you have systems in place. It means that you've organized it, you've created a schedule, for example, because you can schedule out social media. And I suppose effectively it means that you're just being more proactive about your marketing. The other thing that you can look at as well is, say, for example, you can focus on themes. So obviously we're coming up to Easter, we've just had Patrick's Day, you know, Christmas and so on and so forth. So again, you can weave stories and, you know, what's going on in the news into your marketing, and with a content marketing plan, that can work very effectively. So with your content, I suppose a couple of things, and I'm sure you've all seen this before, it's not anything new, but it's about being engaging, it's about being different, and it's about being social, in particular in digital marketing. So for example, if any of you are using or leveraging social media, in particular, it's to remember that the reason it's called social media, it's about being social. So I suppose what I'm saying there is not to be overly salesy on your social media, that you integrate you know, more human posts in the context of maybe giving a shout out to the local rugby team, the local hurling team, if you've sponsored anybody, supported a charity, you know, just happy Mother's Day, just to make sure that you're having the human side integrated into your marketing as well. Because at the end of the day, when you're making sales or you're doing business, you do business with people. You know, and they want to see who are the people behind the business. So, for example, you could have pictures of the staff, if there's been a birthday, and so on and so forth. And I suppose if you bring that down into more human terms, it means that if I'm picking up the phone to any of you tomorrow, and if I go onto social media or onto your websites, and if I see your pictures or see a little bit of what's going on, I get a sense of who you are, and I feel like I kind of know you already. And that can be an important part in the sales process. So just to kind of bring that further along then is, if you think of yourselves in terms of being a fisherman, for example. So as business owners, what you're doing is you're casting out the net, you're pulling in the net, but you're trying to make sure that you're not losing the fish or the leads or the customers through all the different holes in the net. And really marketing is literally like that, because I'm sure we all know we've had leads or people that have, maybe rang or come to your website, and for whatever reason they've gone away. And so the question always is, are you, have you integrated everything? Are you making sure that you're not losing any potential leads? So always to be nurturing your leads. The other thing to remember as well is that, we live in a very busy society, and they say we receive, and studies show that we receive 3,500 messages a day from digital, just driving, TV, whatever it might be. That's a lot. So the question is, how are you going to stand out from the crowd? And in particular, in today's society, people have, depend on their mobile phones, so people are scrolling quite a lot. So if you're scrolling and scrolling, whether you like mobile phones or not, this is what people do, typically speaking. So if your content doesn't stand out, people can scroll on past it. So you've just to think about, what are you posting, particularly on social media, and is it interesting enough for people to stop and say, wow, that looks good, that's interesting, and that they investigate it further. So I just have a couple of samples of some of the posts that we have on REA, and this is just to kind of give you a sense of, what are things you could look out for yourselves. As you can see, this is a Good News Friday, so it's just a good news story. And again, what you're trying to do is, we've many members around the country that are part of the REA organization, and this is just to kind of, I suppose, bring different people into kind of the main organization and introduce them. And again, it shows people behind the brand. It gives a sense. So if you click on those links, you'll see some pictures, but you'll get to see who's part of that particular agency, for example. Here, it's International Women's Day, and to make sure that you're tagging into or latching on or leveraging these hashtags. So for example, hashtag International Women's Day. And lots of people actually ask me quite a lot, what is a hashtag or what does it mean, and is it relevant for business? Do I really need to use it? And it's a very good question. Now, if you're talking to, I'll be very ageist here, to anybody less than 20, they probably are saying something like hashtag I went to the shop, hashtag I went to school, everything is a hashtag. So how is that relevant to business? But if you're looking at this and you see hashtag International Women's Day, or for example, hashtag the Late Late Show on a Friday night, if you put that hashtag into your search on Twitter or in lots of the social media, you will see the conversations, all of the conversations in relation to that specific hashtag. So where that's relevant is that as a customer, if I know that hashtag and I look into it as in I search, I will find all of your content. And or, for example, if you're at a conference like this, and there's a hashtag for today, you can follow the conversation online of what are people saying, are they enjoying it, are they learning something, and also in terms of networking and outreach, you can develop relationships with people through hashtags by reaching out to them because you realize perhaps you're at the same conference, for example. So they're just different ways you can use different social media, and I'd highly recommend that you have your own specific hashtag, but also to be kind of aware of, say, we all know International Women's Day, but for example, even just hashtag property, hashtag community, and if you're in a specific county or a specific area, to use those hashtags as well. Because at the end of the day, what they are is search terms. And you, again, going back to the fisherman, how are people searching for you? How are they finding you? Are you making yourself available? And by using hashtags, by being friendly, having friendly posts intermingled with your sales posts, that will make a kind of more human persona, and people are more likely to reach out to you and to do business with you. So again, just a couple of examples of different posts that we have in REA, and I suppose what I'd say here is you can see that we've used the branding quite well. So again, if you have specific brand colors, just to make sure that you're replicating that throughout your social media, you might ask, is that really important? And I suppose studies would show from academia that if you have good standardized branding and that you're using it consistently, that actually people tend to trust your brand more. So that's worth considering. And I suppose what that's about, again, if you go back to the 3,500 messages a day, people are just bombarded. And if they're trying to choose between multiple providers, how do they choose? And a level of consistency is something that we should all work towards, because again, that demonstrates that, you know, we have attention to detail, that we're working things out, that, you know, things are planned out, and that, you know, gives a sense of and perception of the business itself. So they're just different ideas that you could implement yourselves. Again, I suppose we've just a play of words in terms of using reassuring. You can see that, you know, again, you can, you know, pinpoint different demographics. If your demographic is very young, is 30 to 40, 40 to 50, whatever it might be, that you're using that type of imagery and language in your marketing so that you're appealing to that particular market. And I suppose where that comes into, you know, play is that, do people understand you? Are you speaking their language? So for example, if you were to use a lot of jargon, that might be something that might turn people off, just because they might necessarily understand the jargon. And to be fair, every industry has it, and you kind of have to make a mental note not to maybe be using it as much in your social media, because people just may not understand what you're saying. Again, there's a lot of different imagery. You can see, again, different demographics. Are you focusing on family, for example, and so on and so forth. And I suppose a lot of this is seeding an idea, you know, and it's also that if you've got a level of consistency, and this is where if you're planning out your social media and all of your marketing, it means that people hear you on a consistent basis. And all the time in business, what you're trying to do with your marketing is to be memorable. So if I am looking for your service, you know, and I Google you, so if I look for a plumber right now, you know, typically speaking, they're not terrific at, you know, building websites and whatnot, and usually you have to ring your mother and ask them, you know, or somebody's brother or whatever it is, and ask them for, do you know a plumber? They can be hard to find. So I suppose what you have to think of is, if somebody is looking for your service, will they be able to find you quickly? And, or better again, if they think of your particular service, will you jump into mine straight away? And consistent marketing is the only way of doing that. And Coca-Cola is probably one of the best examples that we all know of. And it's really down to consistent marketing on a regular basis. And I suppose part of that is you might get sick of your own marketing. But in actual fact, if you look at social media, as I'm sure you've all heard, is the algorithms work in a particular way, which means that, you know, if you've got 5,000 followers, Facebook is deliberately only showing your content to 5% of that 5,000 followers. So I'll say that again, they're only showing your feed and your post to 5% of however many people are following you. And so I suppose it comes back to all of us as business owners to ensure that we're constantly posting so that our posts are being seen. That if you get likes, comments, and shares, that's engagement, and that increases your algorithm. In other words, they show your content to more people. Effectively, I suppose what they're trying to do is they're trying to make us pay for advertising. And I suppose you've got to have that workaround and or pay for the advertising itself. Again, it's down to the imagery, it's down to the branding, just to make sure that you're using it and that it's consistent no matter what type of post that you're using. You know, I'm sure you all have logos and whatnot, and they're quite easy to use. You know, and just some of it as well is just more psychological, it's more softer, follow your heart. Again, it's not necessarily salesy, so it's worth looking into, you know, thinking creatively around your marketing and, you know, what is the message you want to say? Is this appealing to the audience? Are they picking up on it? Are we memorable? Will people know, you know, if they're looking for an estate agent or they're looking for a surveyor, are you the first go-to person they will go to? If you're not, what's the next step that they're going to take? Are they going to Google? And typically speaking, in terms of services, you probably find most people go to Google. So, and are you coming up on the first page then? That's the next question. So these are kind of all interrelated questions, I suppose, you might ask yourselves in the context of, is your marketing working well? Or are there gaps in it, and do you need to kind of tighten those gaps to make sure that you're not losing potential leads? Here we have our spokesperson, Barry, who recently was in Ireland AM. And, you know, it was great to get on TV, and, you know, that obviously looks great for brands. And this is something, obviously, many of you can replicate in the room insofar as, you know, if you're on radio, on TV, even if you're not doing that, I mean, you can create your own videos, your own content, and you can put it up there. And, you know, that's a platform that people recognize. And again, they're seeing that brand coming through all the time. And I'll go back again to, you know, having an integrated marketing campaign. So even though that's up on social media, it was originally on TV and he was on radio. So we shared all of that out. And it means that, again, you're seen and heard on multiple platforms. The other thing to consider here as well is that audio search is becoming very prevalent. So for example, Alexa or Siri, if any of you have kids in the room, you might be like my children and they don't actually type anything in anymore. They just talk into their phone and say, you know, when they're doing their homework, tell me whatever it is. They don't. So audio search, is my point, is something to consider in terms of your marketing as well. Again, you know, if you're going to, a conference like today, or you're going anywhere, make sure you're taking pictures. Make sure that you're tagging different people in it. You can tag the venue, for example. It shows that you're learning, that you're wanting to improve your business all the time, and that's worth noting for your customers as well. Like I was saying at the start, we were lucky enough to be featured on The Independent there about 2 or 3 weeks ago, and on The Herald. And again, it's about leveraging that. So it's about putting that out across your different platforms as well. If you've got an email, like MailChimp, for example, you can send that out to people as well. And really what that's saying, you know, to your potential clients is, or to the ones that you have there already, it's reminding them that you're constantly doing work in the background, that you're up there, and this is where it comes down to that recency, you know, that memorable, how memorable are you? And if somebody's looking for your service, are you the service they're first going to think of? Again, just some more examples of, you know, families and people moving in, and, you know, that's quite subliminal. But with the subliminal marketing, you can see the brand as well. And again, that's about the consistency and about keeping your business top of mind. I was mentioning earlier, you know, if you're supporting football clubs and so on and so forth, just to make sure you're doing that as well. Obviously, make sure you've got your brand in the background, you know, because again, what you find is if people are sharing your content out, that it is important to have that branding there, because otherwise it's just a picture and it doesn't actually draw back down and refer back to your business. And that's obviously what you want to do, that, you know, to make sure that your business, your brand is getting out there and people are seeing it in different contexts, not just selling. Again, you can see all the different types, and I'm sure many of you can replicate that across the board. I know we're under pressure for time. I think we're slightly behind, so I won't dwell too long. But again, just recommendations are, you know, daily posting on social media, be it Facebook, Instagram, LinkedIn, and Twitter. A lot of that will come back down to who's your target market. So if they're not on Facebook, maybe they're not, I don't know. You've got to ask yourself that question. I've mentioned their weekly YouTube channel. Most people hate making videos, however, they work really well. So it's well worth doing that. One thing I would like you to note is if you are doing a video and you're posting it on social media, YouTube, and on, say, Facebook or Instagram, Facebook and YouTube don't like each other. So if you put a YouTube link on Facebook, very few people will get to see it. Whereas if you upload the raw file, they'll show it to a lot more. So just remember little tricks like that, because they will matter, particularly if you've taken the time to record your video in the first place. Just a couple of things then about REA in general. I suppose, you know, what works for us. You know, obviously we've got 48 offices and agents based around Ireland, and I suppose within that then you have the facility where they've somebody like myself where, you know, I can work on the marketing for people. They don't have to think about it too much. We operate trainings. And I suppose really what you're looking at there is making sure that your organization is planning out for not just the present, but for the future as well. Because as we all know, you know, with the recent pandemic, which is still going on, the war, things are changing all the time. And the question always is your business ready? And I suppose I would have to say that REA is very good at that. They're planning out in advance. They're making sure that they can, I suppose, adapt and change to different eventualities. And I think that's an important aspect, you know, for all businesses to look at. The other thing, I suppose, as well, I'm sure you all know this in your own organizations, that when you have a multiplicity of people working in different parts of the country, there's knowledge transfer. You know, there's where they can recommend to each other or help each other out and so on and so forth. So I suppose you're looking kind of at a family, if you like, of people that are working under the umbrella of REA brand. And, you know, that can be effective for any business, as I'm sure it is in your own. So for example, other things that we've looked at in REA as well is, you know, online. So particularly with COVID, we have Bid Now, and, you know, obviously that became very prevalent within COVID. And I think it was interesting in general, even to look at shops or, local boutiques in particular, I noticed many of them had not been focusing on their social media or leveraging it for people to buy directly from there. And I suppose when you had a business that you could allow that to happen and to leverage technology, it can work very effectively. So obviously the pandemic has pushed people forward, and it's great, I suppose, that REA have that. And I suppose if you're looking at that, it's well worth the rewards of looking into something like that. Okay, so any questions? Anything you'd like to ask? Oh, sorry, my apologies.
Thank you very much. No, so thank you very much, Emma. I suppose now that we've seen the marketing component of our business and having secured the business, we would hand over now to Ed Carey, and he'll take us through the terms of engagement and so on and so forth. And just by introduction, Ed is, I suppose, 20 to 30 years experience in residential sales, commercial sales, and so on and so forth in the Meath area. And you have a general, you're a past president of the IAVI. So I think you're more than capable to take us through the terms of engagement. So without further ado, Ed, may I ask you to come to the stage?
Thank you, President. Emma, you'll note as my presentation is going on, I have a lot to learn about personal branding. So here I'm promoting the SCSI logo instead of my own. So anyway, we'll see what happens. So look, I want to talk about two things. I want to talk about terms of engagement letters, and I want to talk about a few compliance updates, but it's terms of engagement letters in the context of getting paid. So probably the most important aspect of the terms of engagement letter, and just to see, is there a different way to skin that cat? Because I think we all get paid at the end of the process, and there's an awful lot more that goes into it before that happens. And I suppose it comes from an experience I had a couple of years ago, whereby a couple arrived into my office, asked me to sell the property. So I advertised, put the property on the market, showed the property, took the bids, took the deposit, instructed the solicitor, organised the surveyor and all the bits and pieces. And a couple of weeks after that, the couple arrived back in my office and said, "There's the thing, Ed, we're not going ahead with that." So I had to contact the buyers, of course. You know what way that conversation went, unwind it, get back onto the solicitors, onto the sign guy, delist the property. And after a week or two, I found out by accident that the couple were never actually selling the property in the first place. They just wanted an accurate test of the market price of the property, and I was available and I did it. So I said, I'll settle this pair, sent them out an invoice and was met with that. Okay, not a hope, because it wasn't in my terms of engagement letter. My terms of engagement letter, as the couple pointed out to me, was clear. I get paid at the very end of the transaction on the completion of the sale. The sale didn't complete, I wasn't getting any fee. Okay, so painful and valuable lesson, and I just wondered, is there anything I could do about it? Okay, so, you know, when we look at the terms of engagement letter, at the moment, as we know, we generally operate on a no sale, no fee basis. And, you know, why is that? Okay, we don't just sell properties, as we know. We spent a couple of hours this afternoon learning an awful lot of detail that it's the unseen stuff that we do and what we need to know. We don't just sell properties. We're experts on marketing. Emma gave us a very good presentation. We're experts on planning and building regulation compliance. We've got to be experts on family law. We've got to be experts on contract. We've got to be experts on taxation. Donal gave us a very good interview. And there's a ton of stuff that goes on. And essentially what happens, there's a whole pile of professional knowledge that we bank in the hope that the deal will conclude. And, you know, that's all we have. And it's not really good enough that we hope that that deal is going to conclude. And there's three aspects to the money we take in as far as I can see it. There's our fees, which we get paid for the professional time. There's the marketing outlay that we have for the website listings, the signage, the brochures, and all that kind of thing. And there's the advertising outlay. So there's kind of three different boxes that we have to look at. So in terms of the outlay in advertising, there's no particular issue there. You know, you agree what it is, you send the invoice and you get paid, and that's fine, right? But in terms of the professional fees that we have, there's three, sub-components of that. The first one is, when did the fall due? And usually it's on completion, right? The second one then is, when do we get paid? Which again is usually on completion. And the third one is, what happens in the event of aborted sales? A purchaser pulls out, fair enough, you put it back on the market and you're probably going to resell. But in the event of a vendor withdrawing from the sale, that's a problem. We've done a lot of work. What are we going to do? And usually there's no fee in that event. So there's three areas that I decided I better look at in the context of, is there anything I could do about, is it possible to charge on a fee? So the first one is in terms of the Act itself. The second thing we need to look at is the LOE, the prescribed LOE that the regulator has sent us out that we all generally use verbatim. And in addition to the LOE that goes out, there's notes attached to that, okay? So the very first thing I looked at was the Act, to see what does it say in the Act, because in the hierarchy, the Act is the top. It determines everything that falls below it. So the only reference to fees in the Act is, and I'll read it out for the sake of it, which says that the amount or rate, as the case may be, of any commission or other fee payable by the client under the agreement and the circumstances under which the commission or fee, as the case may be, becomes payable. Doesn't say how much, doesn't say when, doesn't really say a whole lot, just says you got to point it out, okay? So then I had a look at the LOE that the regulator had sent out, right? And in the text of that letter, it's dealt with under paragraph 9.1. And what that says is, the fee shall become payable to the agent on the date the contract for the sale of the property is concluded. And that's a kind of why the no sale, no fee modus operandi has evolved, because that's what it says there. We can't change it, or can we? And the other paragraph to look at, importantly, is paragraph 10, that deals with the termination and the consequences of the termination of the agreement. What happens if the deal doesn't go ahead, okay? And what paragraph 10 says is that the client shall pay any agreed expenses and outlays incurred by the agent up to the date of termination. Okay, so, there's a basis there. And the final part I looked at then was the notes as an addendum to the letter that's on the regulator's website. And what that says quite clearly is that the terms of the agreement in the specified form, which is the letter, the terms of the agreement in the specified form are suggested provisions only, and goes on to say that the client and the agent, the licensee, that's us, may make amendments to those terms of agreement and or agree different terms in respect of the said hearings. So it doesn't specifically say where, when, or how, or anything. It gives the text in the LOE, but it quite clearly says that they're suggested provisions only. So there is an opportunity there in terms of the structure of the Act, the LOE, and the notes, that we can change that by agreement, obviously, with the client, if we want to do that. So very simply, my first suggestion is, maybe your fees or my fees should fall due at the time we go sale agreed, right? Or maybe they could fall due when contracts are signed by the buyer, or maybe they could fall due at exchange. Because, why not? We've done the bulk of our work. We've marketed the property, we've done everything, we've got a buyer. If you're gone sale agreed, clearly the client was happy for us to do that. So the bulk of our work was done. Again, we front load the expertise. We're quite entitled to be paid for it. Yes, there's a colossal amount of work in getting the deal over the line, but sometimes when deals collapse, it's not up to us, the title issue or something that's completely outside of our control. So surely there should be a quantum of fee that we're perfectly entitled to in the event a deal doesn't progress. And the other significant thing then, to try to learn my lesson, is in terms of suggestion number 2, that there should be vendor fees due in the event of the vendor withdrawal. And again, for the same reason, why not? But let's be more explicit about it. So we're talking to the vendor and, we're basically being clear about it, that we've done our work. If you've changed your mind, that's up to you. Everybody else that's involved in the transaction is going to get paid. The solicitor, you can rest assured, is going to send out an invoice. The surveyors or whoever else is involved in it is going to send out their invoice. If they had planning fees due before it went on the market, you know, the architect is going to send out. So everybody is sending around these invoices. They're all getting paid. So quite clearly, why can't we? So again, you know, I'm not suggesting what that amount is going to be or specifically when. What I'm merely saying is that quite clearly there's an opportunity there to do that. I don't believe the regulator would have an issue with it. The main thing is that we're perfectly clear with the client at the outset, specifically what's going to happen and the circumstances, and that we have an entitlement to do that. So that's just the first part that I wanted to say. The next one then that I want to look at is a few items of compliance, right? So, you know, hands up if you like compliance. I don't really do. But there's a few things that have occurred just in my business, probably because of the pandemic, and particularly in the last couple of months, you know, where things have changed, you know, that has made a little bit of a difference, right? And I suppose the main one is in terms of the asking price and the AMV. As we know, significant increase in property prices. So usually you're going to put the property on at 250, 350, whatever that amount is, and it's going to make more. So to be clear about it, there's a section in the Act that says that the asking price cannot be less than the AMV. So we can't send out our AMV to the purchaser saying that it's going to be 300,000, but we're going to stick it on the market at 250. You can't do that. It's black and white. It's in Section 65 of the Act. So what that probably means, a discussion perhaps with your client when the LOE goes out, you know, that there's going to be a correlation between the AMV and the asking price. Okay, so just to make that first point. The next one then is a reminder to myself about the cash origin form. There's a cash origin form that has to be completed for any amounts in excess of €500. So a tenant arrives into the office, pays £1,000 in cash for rent, anything like that. Cash origin form, it's on the PSR website, must be completed. You got to have it, it'll crop up in an audit. The other one then, and again, happened in my office quite recently because of increased property prices. Traditionally, our booking deposits were 5,000 or 10,000 euros. So if you're taking a deposit of 15,000 or in excess of that, you must satisfy the AML requirements for the purchaser. As we know, you have to have the AML requirements for all clients, but any deposits in excess of 15,000 euros, you must have AML for the purchaser. Okay, again, it only cropped up in my office by accident, so happened to me, maybe it's happened to a few other people. I'm referring then also to the Ulster Bank and the KBC withdrawal from the market. I know I bank with Ulster Bank at the moment, they're closing, so I've got to move all my accounts, including client account, to another bank. So there's two aspects there. The first one is that the regulator has to be informed of that. We can have client accounts in two different banks once we have the regulator's permission to do that. But the second one then is that all of the clients need to be informed, and we have to get the permission to move from the Ulster Bank account to whichever bank account it's moving to. So that's obviously going to be a very significant administrative burden. Unfortunately, it's completely out of my hands, but they're the regulations. So all the clients, land letting, residential, purchasers, lettings, everything has got to be written to. And it's not particularly clear what a client is. My own view on it is that a client is the owner of the property and obviously the person that gave you the deposit. So in some cases, you're going to have two people that you need to write to. So just, you know, it's one of those additional administrative burdens that's falling on ourselves, and it needs to be done. And I suppose the final point that I make is comply as I go. It's kind of the easiest. Make sure that as we're progressing along in the transaction, we're getting everything done. Your LOE is signed, your ID is done, your bid forms are being kept, you're printing off the letter from the solicitor that it's okay to give out the keys, and all that stuff. Because when you're closing off the file, it's going to be very, very difficult to go back to the client to look for this piece retrospectively or that piece retrospectively. So that's all I have to say for the afternoon. Thank you, President. Thank you, delegates. And I think there's questions and answers afterwards.
Okay, then we're coming towards the end of the final speaker of this session, and that speaker is Marcus O'Connor. Marcus joins us from the MFO, the property professional company, one of the leading companies in the property industry in Dublin. And their core property services include residential property sales and lettings, commercial sales and lettings, property management, valuation, and building energy rating surveys as well. So Marcus, can I ask you to come to stage where you'll talk about contracts and your tips for sale. Thank you.
Right. First of all, it's great to be back in front of all of you, not doing everything virtually. I particularly like this room because it reminds me of the South County Dublin Hunt Bowls that I used to go to. And the bar was open. Now, TJ, if you could organise for it to be opened later, that would be fantastic. But I'll just get on with my talk. So, great to see you all. The word contracts really means residential lease agreements. So I'm not going to be talking about anything sexy like commercial contracts. This is about residential lease agreements. So moving along, just to give you some quick updates on some legislation that's come in, 3 pieces of nuggets that you can take away today. We have had COVID. There's been a lot going on. Some of us have been homeschooling kids like myself, so you might have missed it. So this is the opportunity to pick up on some new information. So just in regards to registrations, as of this month, it has to be done annually. It's €40. And also, if you have a current or first Part 4 tenancy agreement, that has to be done annually as well. The only ones that get through the net are the further Part 4 tenancies. And if that's confusing you at the moment, come and talk to me afterwards and I'll clarify that for you. So I've been told to swiftly move through this talk, so if you think I'm talking very quickly, it's because we're running behind time. It's not that I want to rush the information or force it on you, so you'll have to accept my apologies on that. Student-specific accommodation. So it used to be the residential tenancies, the private residential tenancies board, then they incorporated all the public property, and now they've gone on top of the student-specific accommodation. So that's now, if there's any disputes amongst landlords and students on student-specific accommodation, the RTB will wade in and assist in dispute resolution, but that will take you about a year. Deposit and rent limitations. So again, just something new. We have a situation where they've put caps on this as well. They haven't just put caps on the rent, they put caps on what you can ask. Obviously, it's to make things a bit more accessible for anyone looking to, I suppose, secure a property. We were doing some viewings recently, and about 20 people wanted it, and of course they're all offering, you know, two months deposit and 2 months rent in advance and so on. We've all had those situations. That's all gone. Forget about it. If you do it, you will get, I suppose, there's a possibility you might get caught out. Now, so moving on to the body of my talk here is why are lease agreements so important? Well, at the end of the day, I'm asked questions about, Marcus, what's the point in having a lease? You know, you've got the residential tenancies board there for disputes, and if anything breaks out, you have to go in there and have an adjudication and so on. But of course, you have to have a lease agreement. It's, you know, it agrees all the main terms and conditions, but also it has, I suppose, a common sense role in regards to making sure that things are crystal clear from the start. What I'd say there is that a lot of us have at the front of the document, this is an important document. Please make sure you read it, and if you don't understand it, get third-party, you know, advice on that. What I'd say is, in our office, we are very, very particular about making sure that our tenants get their PDF copy of their lease before they sign it. We say to them, read this very carefully. And if you have any questions, this is the time to ask, because asking them or crying retrospectively about a particular obligation is not going to work. And we're pretty much that direct. Obviously, we're much politer than that. So, but it can avoid, I suppose, disputes during the tenancy. You know, we have questions all the time on, you know, can you get a gardener out? Oh, the back garden's looking terrible. No, we won't, because if you look at your lease, you are in charge of the garden. And you can use the lease there to cut and paste particular, I suppose, obligations to remind the tenant if they ask questions. And of course, the tone and the script of the email is clearly very important. There are more I suppose, very important reasons to have a lease. And all I'll just say to you is I am a former RTB adjudicator. I do not work with the RTB anymore, so you don't have to throw any mud up here during questions and answers. But what I can tell you for absolute certainty is that all the cases that I handle for landlords, none of mine, I'd like to just make that clear, that come through third parties, the lease sometimes non-existent, or it's just really poor, or, you know, it causes problems. So having a good lease is the foundation, the absolute basics of a good tenant, landlord, or managing agent relationship. So I have been asked to look at leases for people, landlords, fellow agents who've approached me that I have a good working relationship with, and I've known them for a long time. And they've asked me to throw their eye over their lease to see if it's fit for purpose, fit for their daily usage. And I'm always pretty much, I suppose, amazed or gobsmacked at how crap the lease is. And I'm sorry for using that word. I know there's people listening online, but really, I can't really say it, I suppose, in a more diplomatic way. You know, they are really sloppy. Okay, and we're not a sloppy industry, and that really disappoints me. As Ed very, very rightly pointed out there, you know, we are highly qualified. You know, we spend years and years of, I suppose, practicing, getting our experience, and then for some reason, residential lease agreements seem to be sort of the poor sister to everything else. Oh, it's grand. That's told you, you know. Now, of course, not all of them are like that. I'm just saying 99% of the ones that I see are, and 99% of the ones that I see that are going into the RTB for cases are sloppy. So these are just more findings that I have where, you know, there's the absence of particular sections. The parties and principles is missing. The landlord and tenant covenants are missing. There aren't enough obligations, or the obligations are two-liners when there in fact should be a bit more. I've also done, you know, looked at leases where the grammar's wrong, the spelling's wrong. Now, hopefully I have no spelling mistakes today on my overhead projector, but at the end of the day, you sort of get what I'm getting at. It's an important document. It's fundamental to the relationship. So why are we not getting it correct? Or I'm not saying we're not all getting it correct, but I'm just saying the door that I walk into every day in regards to disputes or assistance or helping out landlords or fellow agents, I'm seeing a low level, a poor quality lease agreement. So I'd advise that maybe everyone have a quick look and make sure it is up to date. Now, the next three leases or next three slides, probably the most important slides. Take these home with you. And all you have to do is, if you are in residential letting or management, you can just do a quality check and make sure that all of these items are in your lease. And if they are, you're on the right track. So obviously, you've got your lease agreement cover page, table of contents, parties and principles, legal definitions, tenants and landlords' obligations, special conditions, requirements, statements of information, the signatory page. Oh my God, some of the signatory pages I've seen are just unbelievable. You know, there's no, I suppose, area for witness, no date on it, no reference to what property you're signing on. It's a name, and there's a squiggle, and then there's another squiggle, and it's, I don't know, it just looks like a 5-year-old's done it. Then you have schedules 1 to 5, and those obviously schedules, you know, set out how you arrived at the rent, statutory notice periods, inventory, house rules. Obviously, it's multi-unit development, special conditions, and you have another section maybe for B or cert. Some samples of standard tenant obligations, and there are some common sense clauses. So these are the ones stemming from legislation. We all know them. They're pretty straightforward. They should be all in all your leases. Pay rent, deposit, keeping the property in good order, authorized entry of property, private dwelling, and so on. Then you have what I call the common sense clauses, where you want to try and cover things and prevent, I suppose, things building up, such as damp, mold, or mildew. Isn't that the bane of our life when you're in management? You get an email to say that there's damp or mildew, and you know, you discover that maybe the heating isn't being run adequately, or they're drying their clothes on clothes horses right beside the radiator. So all that lovely moisture comes up into, and then there's nowhere to go, and it just places itself all over the place, in the bathroom and all around the windows. And you know what? You've got to refer them to the lease agreement to say, listen, you can't put damp clothes on radiators. You can't be drying clothes. Do you know what? There is legislation that says the landlord has to provide a washing machine plus a method of drying your clothes, which is generally a dryer or outside, okay? So use the dryer, please. But they're not going to use the dryer because that's too expensive. Well, you'll need to police that, because otherwise you're going to have false claims that there's damp in the property, and off you go to the RTB for, you know, a dispute on that. We've all been there, maybe. Okay. Finally, comparing one clause to another clause. So this is one clause that I saw, to pay a deposit. So, what, 2 lines? Or you can go the other way, and you can do a really good job at it and cover everything, and have the second type of clause, which talks about how the deposit will be handled, when it will be given back, what conditions it will be given back on. So conclusion. There's a large conclusion there. I'm not going to read it because I'm under time pressure, but all I'll say there is that a residential lease agreement is effectively a legal document. It will help you avoid disputes. It will help you if you get into a dispute. Thank you for listening, and I hope you've had a great day listening to all these wonderful speakers.
No, so. Okay, thank you all very much, Marcus. That was as entertaining as it was and insightful, so thank you for that. Okay, at this point, we're coming towards the end of our session. We're going to hopefully have a lively topic of conversation today. This being a general I suppose, session, I would really like to invite any questions from the audience. So can I go to the audience if there's anybody here? Yes, indeed. We're just coming to you now.
I'm sorry about this, folks, but this is a question on tax. I have a situation where I have produced a year ago a probate valuation on a piece of property that's been sold. The property is now going to the market, and with any luck, it will sell considerably in excess of what the probate was a year ago. The executors of the property are the authorization individuals for the disposal of the property. However, there are 4 beneficiaries who are not necessarily the executors of the sale. I understand that the taxes have been paid based on the probate valuation. And let's say, for an example, the probate valuation for the property is 1.5 million. We are expecting to make something over 2 million for that particular property on disposal. What are the liabilities continuing in relation to CAT and CGT, first and foremost for the executors, and secondly on the final disposal of the property and distribution of funds?
Well, I suppose in that scenario, the probate date, it's not a simple question to answer, but there is certainly a gain there, and the gain must be paid by, the capital gain must be paid by somebody. But if you think about it, the beneficiary, let's say the beneficiary receives the benefit at the probate date, at the probate value, and subsequently sells it. Well, there's obviously a capital gain there on the beneficiary. But if you're looking at a scenario where the probate comes out and the estate sells and the property has been valued and the property is subsequently sold by the estate, well then the gain would be in the estate and the beneficiaries would be receiving cash, I presume.
Yeah, that's exactly the scenario that we have
Yeah.
here. The tax on probate has been paid by the estate,
By the beneficiaries.
which is effectively, there is a sum of money inside the estate.
Okay,
So they have managed to pay the tax on probate.
right.
The distribution of the funds will not take place due to the causadils in the will, which is that the property has to be sold. And it's now been sold at a higher value than that value that has already been put before probate. What I'm facing in this particular issue, and why I asked the question, is that we are being told that there's a capital gains tax allowance, there's capital gains tax payable, and there's capital acquisitions tax payable at the same time.
On the gain.
Yeah.
Yeah, and
But I thought we only had to pay one tax. I didn't realize that we had to pay two taxes on the same entity.
well, I suppose the initial entity was real property and CAT was paid on that by the sound of things. There was obviously cash at the estate that the beneficiaries were able to use that cash to pay their initial CAT liability. But now you have a second benefit of cash, which is the difference between the value of the property. Yeah.
The individuals on distribution will be using their own capital acquisitions tax or CGT tax offsets for the sum of money that is actually distributed.
The offset, well, to claim the offset, it must, the tax must arise on the same event.
They'll be using their own allowances.
Well, yeah, I mean, they'll be entitled, like the extra cash that they're receiving is an extra gift, is an extra inheritance in this case. And if there's threshold remaining, that extra cash could be sheltered by the CAT threshold, if there's sufficient threshold remaining, and there's no CAT. But I suppose the benefit has the property would have increased in value, and by the sound of things there, it sounds like the estate itself has a capital gains tax liability.
But it would only be a capital gains tax liability. There shouldn't be a CAT liability.
On the basis that the beneficiaries have sufficient threshold left to take the additional cash, there shouldn't be. But if they receive cash over, so initially they would have paid CAT on the value of the property. I think you said 1.5 million. But if there's so they would have paid whatever it is, 1.5 million divided by 4. They would have paid CAT on that amount. If they receive a further benefit of cash, less the CGT that the estate would have paid, well, that's a further benefit. So they need to make sure that they have threshold left.
Yep.
And they could potentially take that cash tax-free on the basis that they have threshold remaining.
Thank you.
I hope that's
confirmed where I thought we should be, but I've had advice to the contrary. But that's very
right. Well,
thank you very much.
No problem.
Okay.
Thank you very much. Moving on, Donal, I see there's two questions here in front of us. I'm going to go to the first one. So, is forestry land a tax-efficient investment?
Well, I suppose, I'm not really qualified to talk about what's a good investment, what's not a good investment. I suppose the thing about forestry land, in terms of transferring it on and agricultural relief, is that you don't need to pass that 80% test that I spoke about earlier. Mm-hmm. So if somebody has, if the beneficiary has a lot of non-agricultural assets that they won't pass the farmer test, well, that doesn't matter when you're dealing with forestry land.
Okay.
Forestry land, the sale of the trees is free of CGT. There's a lot of benefits to having forestry land from a tax point of view.
Yeah.
But whether it's a good investment versus another investment,
that's for everyone to decide, I suppose. And just in relation to another question there, the agricultural relief, what are the requirements for forestry?
well, I think I just explained it there. I suppose the requirements are less onerous than other forms of agricultural property,
Perfect.
in that you don't have to pass that 80%
Yeah.
test. Yeah.
Okay, perfect. Altogether. Emma, may I come to you if that's okay? And we have, again, a few questions here from the virtual attendees. So, which social media platform should be my priority if I can't choose or focus on them all?
Yeah, it's a very good question, one we get asked all the time, and I guess in part is how long is a piece of string, but it's more got to do with, you know, who is your target market and really where are they hanging out? So what social media are they most likely to be on? You know, obviously, you know, social media is free, but the time required to post on it, you know, as we all know, like resources can be limited. So you've got to look at that in that context. So what I would say is Facebook is probably dying in some regards. However, you still need to have some presence there. Instagram is doing much better in terms of you reach a much wider and bigger audience. However, if your, you know, demographic that you're targeting is not on there, so you might need to be looking at LinkedIn, for example. I suppose a way around it is, to be honest, is having a scheduling tool. So for example, you can schedule within Facebook itself, within the business suite called Meta, or a better way that I found is if you buy or pay for software such as Hootsuite, which is HOOTESUITE.com, Hootsuite.com. It's probably one of the more cheaper ones. It's about $10 or $12 a month or something like that. And the idea of a scheduling tool is that you go in there with your content and you literally just have to tick Twitter, Facebook, Instagram, LinkedIn, and it goes out across all the platforms. You can schedule it out in advance, and it means you can do it, say, for a week or a month or whatever you can do in advance, and I think that's quite beneficial to people. So I would recommend that you would do that, because I just think it's, and if I go back to my content marketing plan, if you schedule it out, honestly, it's just much more efficient. And, because otherwise, as we all know, you can go down the rabbit hole of going on Google and searching for things, and you've lost an hour there straight away. So if you use scheduling tools, you can set it aside and spend the time there.
Perfect. Okay. Thank you for that, Emma. Time is coming against us. So, Ed, can I come to you for a quick question? In relation to terms of engagement, and the contracts and the PSRA agreement, how far can an agent alter that agreement? Do we have capacity to, rewrite terms, or are we abiding by that?
No, the main thing is that all of the paragraphs that are in the LOE must be dealt with.
Yeah.
Okay? Within the paragraphs then, they clearly state, what's in, I think it's in asterisks, can be changed, okay? And the main point that the regulator would always say is that whatever changes you made must be made absolutely clear to the client. Because the main complaints the regulator receives is essentially from a disaffected client claiming it wasn't made clear to them at the start.
Okay.
Yeah. Okay? So the main thing is clarity from the outset. All the details should be dealt with. But if you're thinking of, for example, the one that refers to the termination, and if a buyer introduced by you purchases the property X number of months after the contract is terminated, again, that can be altered, can't be unreasonable. You can't say 3 or 4 years.
Yeah.
I think the standard one says maybe 3 or 6 months. Is there scope to extend that? Probably, but it's clarity from the outset so that if there is a complaint, you have a robust defence.
Perfect, thank you, Ed. And I think we have a question from the floor.
Yeah, there's a question on forestry and taxation. Sorry to bore people about forestry and taxation. But the question is, my understanding, to avail of forestry taxation relief, the legislation states that you must manage the forestry on a commercial basis with a view to profit.
Yeah.
Amenity woodland, for instance, which a lot of farmers and individuals and maybe even people here have invested in, they are neither managed on a commercial basis nor for a view to profit. They are, in my opinion, liable to tax. Liable for tax. I mean, I'm not a tax expert, you are. Am I correct?
So exactly what tax relief are you referring
Well, forestry is, as you say, I mean, there's no tax on the trees. We discussed that today. But there is tax on the underlying land. If there's any capital gains tax, there may or may not be, for instance.
Yeah.
There would be stamp duty. But whatever tax is due on forestry, because amenity forestry is neither managed on a profitable basis or commercially or for a profit, it may be liable to taxation. I think that's something that needs to be clarified by either the state or by tax.
Well, certainly what I know is when you're dealing with, I spoke about agricultural relief earlier on there and the requirement to actively farm the land. So if somebody receives forestry land by way of gift, I know this is indirectly to your question, but if somebody receives forestry land as a gift or inheritance, they don't have to pass the 80% test. But to actively farm a forest, the requirements are relaxed significantly when you're dealing with forestry in terms of the active farming requirement for CAT purposes. There's only so much you can do with there's only so much you can actually do with forestry in terms of actively farming it. It needs to be thinned out every couple of years and things like that, so it's not as intensive. I'd like to come back to you on it to see exactly how that clause in the legislation is dealt with when it comes to forestry land, but I know it's relaxed for CAT, the active farmer requirement.
Okay. Before time is always as our enemy, but before I close this session, can I come to Donal again? Can I just come to you? You mentioned there about a dependent, a relative that's a dependent and property and so on, and that their property, if they're inhabiting that property, can become CGT exempt.
Yeah, so... Yeah.
Can I put a situation to you? So we come across people buying properties for kids going to college or whatever the case may be. And sometimes it's not for investment, it's not for rental to other parties, it's just for that child going to college. What's the situation there if they sell that?
When I say a dependent relative, it would mean somebody that's incapacitated or an elderly parent, for example, would be the typical scenario. So somebody owns a property, their elderly parent is living in that property as their PPR. That's sort of...
Perfect, that's exactly that.
And how long do they have to be living in the property with
suppose
the dependent parent?
It's the longer the longer the dependent relative is living in the property, the more beneficial the CGT relief is, because the way PPR relief works, it's the longer you're there. If you're there for if you're there, or if your dependent relative is there, for example, for 50% of the time that you own the property, well then half of the gain is exempt, just to put it simply. So the longer they're there, the more beneficial it is.
Sure.
Okay, perfect. Okay, with that, I'd like to bring this part of the session to a close. I'd like to thank Donal, Emma, Edward, and Marcus for your contribution and your time and your knowledge today.